I did some research and I put in. So the way I went about it was, okay, so let's put in areas that are $1 million in value currently in typical price, have typical price average of $1 million. Let's see how many of them there are, but we have to filter for confidence, because if we don't consider confidence, we are potentially including areas into our list that have medium or lower confidence, which means that the data that we are looking at is not as accurate. And what I mean by accurate is in properties in liquid asset, which means that it doesn't exchange hands on regular basis as does, for example, crypto and shares, which means that its volatility is much less pronounced. And when you have less volatility, when you can actually easily extrapolate a pattern from a high volume of data, and that pattern remains fixed or solid for at least a couple of years, and then it sort of shifts and changes a little as market dynamics change. So when you have high confidence data, you're looking at statistics and data that fixed or firm for extended periods of time. And only those areas you can make, I guess, a judgment call upon, because other areas, let's say low and medium confidence areas, would be too volatile for you to actually extrapolate a rule or reason from it, So if you include areas that are $1 million in typical value, if you filter out all of the medium and low confidence data, you get 189 areas in suburbs in Australia. Yeah. So when you get 189 suburbs in Australia, then the next question is, okay, how many of those have grown 100% or more in the last decade? Which means that 10 years ago, they were at the 500K mark. You follow?
Yep.
So when I do that, and out of 189 suburbs, 87 suburbs have doubled in value in the last decade. So 87 of those were 500K in typical value, and they doubled to 1 million, which is 46% of the overall $1 million cohort. So to repeat, when you filter 1 million price point, we filter for high confidence, we get 189 suburbs. Out of those 189, 87 suburbs have doubled in value or more, which is 46%. Okay. Then we increase the price point to 1.2 million. Why am I increasing it to 1.2? Because I'm trying to determine the 600K cohort. So I've moved from 500 to 600K to see which ones have actually doubled in value. So when I filter in for 1.2 million, we get 94 suburbs that have high confidence. Yeah. So we get less suburbs than those that are 1 million. 1 million had 189 high confidence. 1.2 million has 94 suburbs high confidence. Now, when I filter in the growth patterns across a decade, and I set it growth in the last 10 years to be 100% or more, I get 44 suburbs, which is the same as previous cohort. It is 46%, which is interesting. So essentially suburbs that are 500K in value and 600K in value have a similar potential to double in value on the basis of current 1 million and 1.2 million cohorts. Does that make sense? You following?
Yeah.
So that's surprising to me because, again, it's interesting. Data can really disprove your biases. And this is what I always say is, you hear me say this a lot. When we're filtering these days, I don't even consider the names of the areas, the location of the areas. I just let the data speak, because I find myself, when I'm trying to research, I find that, let's say if I'm trying to research for someone that I really value, or I think it's going to be a huge value add to our business, I want to essentially impress them in a way. So when you have that emotional element of trying to impress someone, when you're filtering or when you're trying to research, your bias is even more pronounced. So when you're looking at, and you're much more concerned you're going to make a mistake, and you're driven by fear. And when you're much more concerned that you're going to make a mistake because you want to impress someone, your bias actually amplifies. And because it amplifies, even when you look at a certain area or certain location, you're like, let's say you look at a short list, your bias is telling you it's probably that one. Or and then you get humbled if you follow through the whole process or our methodology. You get humbled in the end that 99% of the time it's not the area that you assume. Now it's the same with price points. I had a bias. I was thinking that surely the 600K areas will have more potential to grow in value than the 500Ks, and it's actually dead equal. And the reason why I assumed that is because what I said previously, I thought that the fact that it's 600K in value as opposed to 500K, there are certain economic drivers within the area that are going to make it, they're going to push the area harder and enable it to grow and double in value at a much faster rate than those that are 500K. And usually what I mean is, for example, the 600K areas have an ERSAT or a socioeconomic score that's on average, on percentage base, higher than those that have that 500K area ERSATs, So I thought the socioeconomics are going to push it higher. I thought the stability of those markets is better, hence they have, more opportunity to grow. But if we look at the data, it's essentially very similar. Close, it's 46% both, which I was very surprised about.